Okay, folks, our Wednesday review for week ending March 22nd, 2019. We're going to be looking at the dollar index briefly, the euro dollar, British pound versus USD, and some notes and ideas for studying trading big figures. All right, folks, we're looking at the dollar index. This is a daily chart. Now, obviously, we look at the previous 2 weeks' weekly review and pre-market analysis for the week to come. This will all seem rather cherry-picked otherwise. Okay, so go back and watch those videos. So we're looking at the dollar. We were expecting the downside delivery on price running below this low here, and I had you focus right in here between these two candle bodies and the mean threshold of this down close candle. Okay, so we went through it today, traded rather aggressively on the heels of FOMC. Beautiful delivery as outlined on our analysis. So plan A, again, was weaker dollar. Admittedly, we had the expectation, should we have opened up, so in other words, if we gapped up, I mentioned we were going to watch this level in here. If we traded through that, that would have been some measure of changing tide, if you will, on my bearishness on the dollar. But obviously, we have to wait till Sunday's opening. Sunday's opening did not see that gap up. We've seen price trade lower in alignment with our plan A of bearish dollar index. So this is pretty much done. We fulfilled our analysis for the week. So it would be foolhardy for us to try to go in and force setups now. Now, it does not mean you can't go in and practice. It doesn't mean you can't go in and study your institutional order flow, entry drills. Those can be done on a day-by-day basis. It doesn't make a difference what goes on in the marketplace because they're all exercises. They're not trying to make a profit. They're not trying to, reduce a loss or come back from a drawdown. None of that is any bearing on the practice aspect of using the institutional order flow entry drills. So, with that in mind, I have zero bias the rest of the week. I have no expectation on what should take place. I'm just reviewing today. There's nothing for me to say, okay, Lana, look for this. Okay, just be mindful of that. So, we've had a really nice delivery. Went through the middle of this down close candle. Came off of that a little bit. We'll be watching to see if we can come back up to this low. It doesn't have to do that. In fact, it'd probably be better if it didn't do that, just kept on going lower. But if it does, we could do some institutional order flow entry drills on that. Once it hits it, look for a gap to form as it moves away from it, and then maybe look for some shorts to retest this low or make a run for the attempted running at this low and this low as well. Now, these two lows here are relatively equal, and then we have this area right in here. Now, this candle's high, extend that out from here to this low. That's the gap. Okay, so I'll show it to you like this. So there's your gap. Okay, so inside of here, it is buy side imbalance, sell side inefficiency, or BISI. So we'll be looking for maybe, if we can get below this low, some attempt to get down in here and run that out. That could be in alignment with the seasonal tendency that we've been expecting for the last 2 weeks now, well, a week and a half, for a bearish dollar, at least going into May. So that could accelerate and get down here. Then things could be interesting. Maybe we could, at that time, maybe revisit the idea of taking out the buy side liquidity up here. Moving on over to the euro dollar. This is a daily chart. There was 2 price points in here that I had everyone focusing on. It's going to be this old high. And again, if you didn't watch the last 2 weekly reviews, again, it's of no benefit to you listening to me talk about what's already happened. It seems like cherry picking. But we also have this area in here. Okay, here's Wednesday's trading, Tuesday, Monday, Sunday, and here's the high that was showing on Friday's close, and this low right there. And I'll darken this up so you guys can see it. And draw that out in time. And this is going to be important in a moment as soon as I get down to a lower time frame. But I mentioned that I was going to be studying this area in here because if we had an unwillingness to trade through this level and move away from it, that would be indicative of the need for it to trade lower. But again, plan A was we looked at this low here as a stop run on that low. Seasonal tendencies, looking for higher prices on euro dollar, lower prices on dollar index, and bingo, the voodoo has came to fruition. Well, when we go down to a lower time frame, I want you to study how this shaded area, and again, go back and look at last Saturday's market review. Okay, it's based on last Friday's close or March 15th. So when the markets were closed, I gave you that video on Saturday, and I mentioned that this area is going to be important to me. So if we drop down into a 15-minute time frame and scrunch this up a little bit, not so much. Okay, look how much time we spent in that area. Okay, so it worked all kinds of buy and sell, buy and sell, buy and sell. It accumulated all inside that little shaded area relative to the fair value gap on the daily chart. So you can see how much of an institutional effect it has in price, or I should say it this way, how much of a effect price has for institutional trading, because they were accumulating in here, ran some stops below this low here, relatively equal lows in here as well. Nice little drop down, market protraction, and went higher, retracement right before the expansion during FOMC. This level here is that daily high. Okay, so 114.18, that was the level relative to a daily chart. If we're long, if we're looking for upside momentum, you got to look at the daily chart and where old highs are, okay, or old lows. But because of the chart on the daily only showing a significant old high, not an old low anywhere in proximity to where we were right before FOMC's news driver, when the volatility came into the marketplace, it went aggressively towards that old daily high. Now look at how much time it spent there. If we watched this live, okay, it was almost like instantaneously. Okay, inside of like 10 seconds, it was like cruising up here like this. So even though this is like one candle for a 15-minute range, most of this was done in seconds. Like it was like booking. It was really taking off. And it repriced right above that old daily high. So that's going to be significant. If we take a closer look and drop down into a 15-minute time frame with some more lipstick on it, here's the Asian range. So we have the Asian range here, and if we're bullish, now assuming that it wasn't FOMC, okay, say it was some other news event that was due out in New York, okay, so maybe it was relative to the dollar index. As it was today, the Fed came out and said that they're unlikely to have any rate increases for the rest of 2019. Okay, great. I mentioned last year that we would probably have a rate increase or a series of rate increases, and maybe one in January. Then we'll see what happens. Well, it just so happens that a week and a half ago, when we did our quarterly analysis, the seasonal tendency was suggesting that there would be weakness in the dollar index and upside potential or seasonal strength for foreign currencies. Isn't it convenient that the Fed comes out today and says there isn't likely to have any more rate increases? So that's going to do what for the dollar index? Is that going to attract foreign investors to pour money into foreign currency or dollar index? Well, they're certainly not going to raise interest rates on the dollar index. So the interest in seeking yield, or the increasing of that yield every time the Fed hikes up interest rates, that interest in buying dollars has been quelched. It's been more or less dampened. So that allows the seasonal tendency to have a greater impact on what price is most likely going to do over the coming weeks and months. Now again, we're bullish foreign currency until May, and we're bearish US dollar until May. Now it does not mean that they're going to create significant turning points at that time. We'll have to obviously look at it again on a quarterly basis, but for right now, that's the narrative we're sticking with. But isn't it interesting how all of these quote-unquote fundamental things that come out in the Federal Reserve, I don't know what they're going to say. I have no idea what they're going to say. I don't sit here and try to decipher bank reports because I don't believe that the banks are going to tell you what they're really trying to do. Okay, the bankers are not going to sit down and say, okay, let's go out and help John Q. Public. We're going to tell them everything we're going to be doing. Okay, that's not what happens. Okay, so that's why I stay away from that fundamental stuff, and I stick to what I know the algorithm is most likely going to do relative to seasonal tendencies and time and price. So, with that said, we have a run above the 114. So it expands. Once it hits to a big figure, then you know what? It can go 10, 20, 30, 40 pips. Whenever we hit a new figure, IPTA can always expand beyond that. Well, price trades up into a high of 1447, so almost a whole half of a figure. So just fell short of the mid-figure 50 level. The old high, 114.18, if you go 30 pips above that, that takes us to 114.48. And on here, it just went to 47 and a half. What I guess that would be rounded up to 48, maybe, I don't know. But we're going to stick with the numbers 47. That's close enough for government work. Beautiful delivery of repricing to an old daily high. And that old high is February 28th, 2019. So if you want to go back on your charts, or if you want to include it in your own notes, just be mindful that's what you want to have on there. And if we're bullish, okay, as we were going into this week on foreign currency, there's two different filters you want to use for going long. Okay, during the London Open or London Open kill zone, the ideal scenario is you want to buy below the Asian range low. That's what this is here. Okay, but as the day progresses, once we get into New York or New York close, or it could be London close, either one of those time frames, and yes, I said that right, New York close, which is around between when bonds close and the stock market closes. Okay, so that's basically the sweet spot for New York close. Generally, that is only a kill zone that's going to be important relative to continuation patterns. So in other words, if there is a runoff move it's begun on the upside, many times you'll get an Asian range that just continues right on through in a trending style after what has formed in between 3 o'clock and 4:15, 4:30 in that area, New York time, local time. So for the time being, forget New York close as a kill zone, because it's so much information that's necessary for that. Because I already know what you're going to be doing. You're going to be sending me emails. Can you tell me how to use the New York close kill zone? It's going to be in future lessons. Charter members in that area. Okay, so because it requires a lot of filtering and certain things to be in place for it to be used. But getting back to what I'm saying here, if we're bullish, okay, we want to ideally buy below the Asian range low. That's when you're going to catch the Judas swing. Okay, so the market goes in protraction here. Beautiful. Okay, buy it. But let's say you can't be up during London Open. How can we look to enter a trade based on the Asian range? Asian range high, you extend that out. This is your last line in the sand, okay, for like high probability entries. So you want to be buying below the Asian range high, price drops down, trades back into an area of liquidity, runs out equal lows here. Sell side liquidity has been absorbed. Price takes off for FOMC. Now, I'm not telling you this to go in and trade FOMC market releases. Okay, I'm not saying that. I'm just saying this is how you study it, and you can study and watch how price is delivered around them. Any other news event, and again, let me preface it by saying this, FOMC or non-farm payroll, we don't do anything with either one of those. There are no touches, okay? But if it's any other market release that's due, high impact or medium impact, you would still use this criteria, okay? And you can still get sometimes, many times, like runs like this on lesser news drivers. So don't think that you can't see these types of events on It depends on what flavor of the month is going on, because sometimes they watch housing numbers, sometimes they watch employment numbers changing, sometimes they watch PMI. All those things, they shift in and out. They don't always stay, the one that's mostly watched at any one time. So in other words, they cycle in and out. Whatever fundamental driver that is expected to be released for a currency or even a commodity, they cycle in and out. Okay, just know that they're not always going to be impactful on the same magnitude. Sometimes they'll be, for instance, employment numbers used to be really, really wild. It would cause a great deal of volatility in the marketplace, and not so much now. No one's really paying attention to employment numbers right now, and they're watching other factors. And I think mostly it's been interest rate driven, because we've been in a very, very low interest rate environment. So any discussion of rate increases really gets the economy stimulated, at least the speculators stimulated, and there's participation. So with that in mind, if we're bullish later in the day after London Open, you're going to be using the Asian range. If it drops down below that, then that's a filter for a high probability, low risk entry. Okay, so let's go over to Canadian dollar, and I want to talk a little bit about big figures. Okay, this is something you can study and practice, and again, this will help you with, number one, it'll help you with market structure, it'll help you with entries, it'll help you with trade selection, it'll also teach you fair value. Okay, so again, this is just like I mentioned before when we were talking about institutional order flow entry drills. You're going to use the lowest leverage possible. So that means if you can trade with 1 penny, okay, for every pip that you're trading, okay, that's what you're going to do. You're not trying to make money on these things, okay? It's to help you train your eye and look for setups. Now, if you were to look at this and understand it and study it, you're probably going to want to come back to this portion of this video a couple different times to make sure you make a notation in your study journal about big figures. This is one of those videos you want to come back and look at. Everything I'm saying here can be done with mid figures as well. So in other words, 50 levels. Okay, so 0 levels and 50 levels. If you study just those two price points and you study them around time of day, day of week, and use institutional order flow, the things that we've highlighted about what we think is going to happen relative to our weekly analysis going into the new week, all of those things, and understanding where the draw on liquidity is going to be next. If you blend those together, you can start fleshing out a rather crude foundation to a trading model. And it can always be hinged on a 50 level or a 0 level. Okay, so what's a big figure level or a 0 level? 132 even, 133 even. Okay, a 134 up here would be 1, and 131 even would be 1 down here as well. That's a big figure. A mid figure is, for instance, 131.50 or 132.50 right in here. Okay, or 133.50, which would be somewhere up in here. Any one of those levels, if it trades there, you want to watch and study how price trades around it. And I'll give you some examples of what you're looking for. Price moves away from the big figure. After it hits it here, it trades up through 132 big figure and then retraces. Then it runs through it and then comes all the way back down later on. When price is starting to drop down into that big figure, you want to be looking at any time a currency is trading down to or up to a big figure that it hasn't been at for a while. Then you want to look for any kind of gap, any inefficiency like we see here. We have the down close candle here, and then we have this up close candle here, the low. In between those two price points, the high of this down close candle and the low of this up close candle, there's your fair value gap. You split that gap in half. Remember, it's the same protocol I gave you for institutional order flow entry drills. That's all you're going to be doing. You're splitting the gap. Then you're going to add the spread to the gap if you're buying, or subtract it from the middle of the gap if you're shorting it. It hits it beautifully right there on the midpoint of the gap and then rallies up. What you're looking for is 30 pip moves. That's it. You're not looking for 100 pip moves. You're not looking for 50 pip moves. you're looking for 30 pip price runs. That's it. Why 30 pip price runs? Because when prices are trading at that big figure, remember how I opened the video up? When we traded to the 114 big figure on Eurodollar, I mentioned that whenever price trades to a big figure, it can go 10, 20, 30, and 40 pips above. Now, we're not looking for 40 pips because that's the high end or upper echelon of targeting for liquidity sweeps around the big figure. Think of the big figure and mid figure levels as the double highs or double tops and double bottoms, or we call it Candyland. This is a dynamic range where there's going to be a lot of orders that stack up and they come in and out of the marketplace. What do I mean by that? There's going to be a lot of liquidity around this price level in a range, okay, of 20 to 30 pips above it and 20 to 30 pips below it. So I'm not going to do all the work here, but you can pull up your dollar CAD chart on an hourly basis, basically flesh out what you see here, and then I have some more things over here when I scrub to the left of it, or to the right of it rather. But you want to see and study how price moves and gyrates around these big figures, but it's going to key off of not only the big figure or just below it or above it, but it's going back at an imbalance, because IPTA will look to these big figures and mid figures and find the imbalance where it has a need to come back and rebalance it. This is a beautiful example, and without any question, it went 30 pips above it. Ended up going a little bit higher, clearing up some relative equal highs. That's not the point of the exercise. Here we have an example where price trades down through the big figure, 132. We have a gap right in here between the high here and this candle's low right here. Goes right to the midpoint of that and expands down and trades again 30 pips. Price comes back up. We have a small little gap in here from the up close candle and this high in here. It goes beyond it just a little bit. Again, it's not the point. You're looking to study how price reacts at it. It trades from here, trades down, again, 30 pips. There's another fluctuation that's tradable and doing exercises on. There's really no gap in here except for this little tiny thing right there. And price comes all the way back up to it and trades into it here, but does so on an imbalance of its own. Doesn't really give us anything to work with. We'll just say if you exercise on it, it would have been a quote-unquote negative result. We're not saying profitable because it's not about being profitable. Then we have another run down through the big figure. Now look what happens. It creates another gap. Here's this candle's high here, and this candle's low. Split the gap in half, trades to it perfectly, trades down 30 pips. Okay. Right away, you can see it's not happening every day, but it's every few days it's happening. And this is just one currency, dollar CAD. How many big figures are there? There's a lot of them. So if you look at the majors, it gives you an opportunity to go in and study price action. If there's nothing to do, if you've done all your trading or whatever, or if you just happen to notice that there's a major coupled with the dollar index that is approaching a big figure, study it and see if there's a gap. If there's no gap, or if it isn't obvious, then don't do anything with it. But if it is, this is how you practice. Another example. Right in here, price trades down to the 133 big figure, bounces, drops back down, closes in a gap. Here's the low of that candle, the high of this candle, split the gap in half. That's where you would buy plus 3 pips and expect a run of 30 pips. Beautifully done. Okay, very, very systematic. Now, why does it work again? It's because around these big figures, there's going to be gyrations of 20 to 30 pips because it's going to be seeking liquidity up and above and below those big figure levels, especially if it's in a consolidation. But if it's not in a consolidation and if it's in an existing trend, you can look to see it go below the big figures, clear up some liquidity, and that's where you're going to be buying when you're bullish, or running above the big figure, sweeping out some buy-side liquidity when it's bearish, and you'd be entering above that. And it'll help you understand how we move from premium to discount, how we can work within a specific market structure to find setups that are always going to be there. They can't hide it. It's a footprint in the sand all the time, and this is how you find it. Study your dollar pairs, okay? Don't try to do it in crosses and stuff. You can do that eventually later on, but try to do a month or two of just studying big figures and mid figures. The same thing occurs at the 50 levels. I've given you enough to study for right now. Start building some notes on it. Don't share it online. Don't send me things in Twitter, and you don't need to send me anything in email because you guys are sending me a lot of stuff. I know it. Okay, I understand your excitement. I appreciate you guys just saying, "Hey, look, I appreciate I understand the lesson now. I learned more about it. Great." But please don't send me like these big long, essays, or I don't have time to read all that stuff. I can't. There's so many of you. I can't read that. Try to keep your responses or emails to me as short as you possibly can, and treat it like a text. Like if you were going to text me something on your cell phone, you wouldn't be sending me an essay. It'd be like a real short statement or a comment or a question, and there it is. Because that's how I most of the time respond in the emails. And I don't do that to be rude or to shortchange you. I have so many of them. I try to keep it as brief as I possibly can. Brevity is a best friend for both of us in this, okay? So again, I'm not going anywhere. So just relax. If you don't feel like you got it, that's the benefit of studying it, because that's the goal. You'll get it by studying it. I'm not going to be able to bridge any gaps for you apart from what I just gave you here. You study it, you'll see it, you'll know what I mean once you start doing it, okay? Again, there's several majors coupled with the dollar. If you study them, you'll see it, okay? And I will talk to you folks on Friday. Again, I'm not really looking to do anything the rest of the week, but if I can find something to do, like a live exercise with institutional order flow entry drills, I'll try to do it Thursday or Friday. And until I talk to you on Friday, I wish you good luck and good trading.